Good day, traders. 1 minute mindset reset. Today we're talking about the opening range and initial balance, Monday, Tuesday. So today we had Tuesday, no major red news on the calendar. And I want to reinforce the importance of understanding what the opening range is. When we start a new week, we have a new timing cycle, a new week, a new high and a low of a week. And so sometimes those opening ranges may take out a weekly or a monthly high or low on a Monday, and we'll see a peak formation reversal. But we will also potentially see opening ranges that are inside of other ranges from previous weeks, and the initial balance, the Tuesday range, may break a level or trade into a level and reverse, or break out and reverse. And at the close of the day, we either have a market that has pulled back inside of Monday's opening range, and we have a high and a low over a week now, heading into day three. Day one, day two. Day three may end up being one more push into a lower high of a week for a Thursday reversal, or a Thursday breakout trade, or a breakout on Wednesday, that now we have breakout traders in the market. But that opening range and initial balance forms a box. Peak formation, high and low. There's your high and low for the week. It forms a box. If it breaks out of the opening range, we now have day one breakouts in the market at the close of the day. At the close of the day. So I've got traders messaging me and saying, oh, it's a first red day. The day's not even closed yet. Or yesterday's a first red day, except we didn't take out a weekly level. So when the opening range and initial balance is trading, step back and understand they're setting a box up, a new weekly high and low for now you have your range for the week. So traders are transferring previous week's information, and when we haven't broken levels, like we saw a breakout of Friday's low of the day on gold on Monday. It was a day three. So I answered probably 100 responses yesterday, an email and comments. Why was it day three? A failed breakout starts the day count. So day one, day two, day three, we broke out, but take a look at the chart where the trap volume was. I said this yesterday, Asia, London, New York, all completely outside of the previous day's low of day. When volume gets trapped, when the market, I said this in the community post today, one push, two push, three push. The name of the game is to trap traders up high or down low, hold them there and keep trading and getting more traders on board. Maybe run their stops like gold. So one of the attractions of gold is the volatility. One of the challenges that traders face with gold is that they get into markets where there's no setup and they get whipsawed and they say, oh, it's too volatile. But if you step back and let the market set up, there are plenty of opportunities that aren't volatile, where you're in the market, in a trade, you're out of the market, and then you're done. There might be a second hour trade as there was today. There was a fourth hour trade today. 1 hour, 2 hours, 3 hours, fourth hour trade. As I repeat, 1, 2, 3. But that was a 75 pip box. And there was a couple of fantastic opportunities for parabolic shorts. So the opening range and initial balance, I encourage you to go back through 100, 500 weeks of data on different instruments, mark off your Monday. Figure out where you're at in the relation to a previous week's high and low. When Tuesday trades, does it break out at the close of the day, or does it pull back inside? I'm not talking about breakouts and pullbacks. I'm talking about, is it close inside of Monday's range? Now there's your high and low for the week. Or does it break out? Now we have day one breakouts in the market. We could go Tuesday, Wednesday, Thursday for a reversal and not even break out any more levels. So these are the things that you need to be thinking about, because they're the setups that will develop into parabolic opportunities, whether they're trend trades or reversal trades, for an explosion of 50, 75, maybe 100 pips, depending on the instrument. Indexes can easily do 100 plus. Same with gold on a day three reversal or a day three trend trade. So the power is in understanding the opening range, because at the end of Tuesday, you're either going to have a market that's in breakout or a market that's inside of Monday's range, and there's your high and low now for the week. And that's significant because you have a market that's still inside of a box. If the market breaks out of the box, now we have breakout traders in the market. And that's important to understand as well, because we have breakout, day three breakouts, we have 3-day setups, and we have Monday, Tuesday, Wednesday, Thursday, Friday. parabolic opportunities. So I know I'm going to get a lot of emails about that too. Step back, understand how money is made. And it's not made by just trying to buy the low and sell the high and get in and get out. Think about where the setups are that you can actually put size on, because they have traders trapped. And what I mean by that is, I talk about lifting the offers and pulling the bids. How does a market just drop 50, 75 pips straight down? But there's a trend. How does that happen? This is why all of your indicators are useless, because it has nothing to do with indicators. They build up a market, they manufacture that. Look at gold today. Asia, London, slightly higher high in the gap. That's the high of the day. 759, draw your high of the day. 15 minutes breaks out, second 15 pulls back inside, a vertical 50 pips, down to double zeros. They pull it back, 9:30 New York, straight down, 75 pips. Same trade as the payrolls without the payrolls. And it wasn't a day three. Same trade setup. Breakout pullback, New York open, straight down to the low. Go look at non-farm payrolls. Non-farm payrolls release, go look at the chart. Drop volume, breakout pullback, 9:30, straight down. Same setup. Different day, different type of variables, same setup. So focus on the opening range initial bounce, study the templates, understand the type of template that you're trading, and don't just try to be catching knives or getting in front of rocket ships, because that is a way on the wrong day that can smash you and blow out your account. So don't confuse getting pips with a scalable rinse and repeat opportunity that you can put size on. That's all I'm trying to emphasize. So it's a good day. That's a day two. Tuesday's day two. So anyways, traders, keep it simple, but step back and really understand the power of the opening range and the initial bounce. It's a box, and it's either broken out of the box, opening range breakout, or we now have our high and low for the week, and that's our reference points now for parabolic opportunities, either Wednesday or Friday, or maybe even Thursday, an inside day, all those sorts of things. I don't believe we have any major red news on Friday, so if there's no major red news, pump and dumps, dump and pumps. Simple trade setups, stick to the plan. Oil, a fantastic day two. Breakout of the opening range. They dropped it down, 150 pips. Went sideways in London, trap volume down low. Jammed them into the peak formation from London. Third hour explosion for a short squeeze reversal back to the high of the day. Straightforward. So one more thing. Hourly charts, 5-minute charts. Hourly charts remind you of the importance of time rotation, not because I'm trying to trade the hourly trend. It reminds you that a 1 hour trade can be 50, 75, 100 pips, and if it's still going, let it run. Keep it simple, step back, understand time rotation, use your smaller time frames and your levels once you have that confirmation to be able to get into the market, manage your risk, put in a profit target or taking some money off, letting a runner go, whatever that is. But lock the money in. Don't hold on for a 700 pip move. You can do that if you want, but scale it up in size, rinse and repeat. Have a great day, traders. May the markets go with you.